When money suddenly gets tight, one of the first things many investors consider is cutting their SIP. After all, why keep investing 10,000 or 20,000 rupees every month when you need that money right now? But there's another option. Borrow the money and leave your investments untouched, which raises a slightly uncomfortable personal finance question. Is it actually smarter to take a loan than to stop your SIP in terms of emergency? The answer depends heavily on what kind of a loan you're taking, how long you need the money for, and whether you can comfortably repay it. Hi, I'm Nupur and you're watching Control Z, your cheat code to navigating adulthood. Now let's separate three things that are often treated as the same decision: stopping your SIP, redeeming your existing mutual funds, and taking a loan. They are obviously not the same. If you temporarily stop an SIP, you're simply not making new investments for that period. Your existing mutual fund corpus remains invested. Now, if you redeem your mutual funds, you're actually taking money out of the market, and that can have additional consequences including exit loads, capital gains tax where applicable, and the loss of future compounding on the money withdrawn. So, if you need cash temporarily, pausing an SIP can be less damaging than selling investments altogether. But should you borrow instead? Well, that depends on the interest rate. Suppose your emergency option is a credit card balance or an expensive unsecured personal loan. You could potentially be paying 20%, 25%, or even 30% interest on that debt. In that situation, continuing an SIP simply because you don't want to interrupt your investment journey may not make financial sense. Paying 20 to 30% interest while hoping your investments generate similar returns is simply not a good trade-off. In that situation, temporarily pausing the SIP may be the better option. But there's another type of borrowing worth understanding: a loan against mutual funds, or LAMF. Instead of selling your mutual fund units, you pledge them to a lender and borrow against their value. Your investments remain in the market while you get access to cash. These loans typically carry interest rates of around 9 to 11% a year, depending on the lender and the type of mutual fund pledged. For a short-term cash crunch, that can potentially be preferable to liquidating a long-term investment, provided you have a clear repayment plan. And here's why preserving your investments can matter so much. See, take someone investing 20,000 rupees every month through an SIP. Now, if they stop investing for an entire year, they miss 2.4 lakh rupees of contributions. Assuming a hypothetical annual return of 12%, if that 2.4 lakh rupees had remained invested for another 20 years, it could have potentially grown from 19 to 20 lakh rupees. Now that's an opportunity cost. Of course, these are illustrations based on assumed returns. Market returns are not guaranteed. And this doesn't mean you should borrow money at any cost just to protect your investments, because loans against investments have risks too. Your mutual fund units are being pledged as collateral. If you cannot repay the loan, or if the value of your pledged investment falls sufficiently, you could face additional requirements from the lender and ultimately risk having units liquidated. So here's a useful way to think about the decision. If the emergency is temporary, your income remains reasonably secure and you can access low-cost borrowing that you can comfortably repay. If your only borrowing options are high-interest credit cards or expensive personal loans, temporarily reducing or pausing your SIP could make more sense. And if your income itself has become uncertain, for example after a job loss, adding another monthly EMI may make your financial position worse. In that situation, protecting your immediate cash flow takes priority over maintaining an investment streak. Ideally, you shouldn't have to choose between debt and your investments in the first place. That's what an emergency fund is for. The broader recommendation is to keep around 3 to 6 months of essential expenses somewhere accessible for precisely these situations. Because your SIP is designed for your future goals, your emergency fund is designed to stop today's crisis from destroying those goals. So when an emergency hits, don't automatically stop investing and don't automatically take a loan either. Look at the interest rate you're being charged, how long the cash crunch is likely to last, how easily you can repay the debt, and what you're giving up by touching your own investments. Because sometimes pausing an SIP is the cheaper decision, sometimes borrowing is. And sometimes the most expensive option is choosing without doing the math first.